How have seed investing trends evolved for startup founders? Imagine trying to build a house with a blueprint that keeps changing. That's how raising a seed round feels today. The landscape for early-stage funding has shifted quite a bit over recent years. Seed investing is still the first big step outside your own funds, helping you turn your idea into a real product, hire your first team, and start gaining customers. But in 2025, investors are more selective. They want to see a clear vision, early signs of product-market fit, and solid growth potential. This means your pitch deck needs to be detailed, showing realistic financial projections and a strong story about why your startup will succeed. We're also seeing more sector-specific microfunds popping up. These are small funds, often under $20 million, that focus on specific industries like consumer goods or deep technology. They bring not just money but also expertise and connections in their niche. If your startup fits their focus, your chances of getting funded improve, and you gain access to valuable industry networks. Funding sources have become more diverse. Besides traditional angel investors and larger venture capital firms, many new small funds are stepping in. These micro-venture capital funds are filling gaps left by bigger firms pulling back from early-stage investments. For founders, this means more options but also a more fragmented landscape to navigate. Investors are now paying close attention to how efficiently startups use their capital. Showing early traction and lean operations can make a big difference. Many seed-stage companies are using technology like artificial intelligence to optimize their growth and demonstrate progress. This focus on efficiency helps attract follow-on funding, especially when market conditions are uncertain. Networking has become more important than ever. Founders need to build genuine relationships with investors who understand their sector and investment style. Clear communication and transparency are key to gaining trust and securing funding. It's not just about pitching once, it's about ongoing engagement. Legal and financial preparedness is also vital. Founders must understand how equity dilution works, what rights investors will have, and how future funding rounds might affect their control. Having a solid legal foundation can prevent surprises down the line. Market conditions influence seed investing too. When initial public offerings slow down and later-stage investors become cautious, seed investors tend to be more careful. This creates a challenge for startups trying to raise subsequent rounds without strong growth stories. For founders looking to network and raise funds today, it's about targeting the right investors, preparing detailed financials, and telling a compelling story about your growth potential. Building relationships early and understanding the evolving investor landscape can make all the difference. In the end, seed investing has become more strategic and relationship-driven. Founders who stay informed, adapt their approach, and focus on building trust will find it easier to navigate the early funding environment in 2025.